Hello and welcome to Strategic Alternatives, where we uncover new ways to raise capital, drive growth, and create value in an ever-changing world with insights and outlooks from the RBC Capital Markets team. I'm your host, Vito Sperduto, head of RBC Capital Markets US, and today I'm joined by a multi-time return guest, Joshua Rosenbaum. Josh is the global head of Industrials here at RBC Capital Markets. This will be a very timely episode because we're going to talk about the state of play across the industrial space in general, which I think it'll be some interesting trends for everybody to consider, as well as some thoughts on the themes that we heard at our Global Industrials Conference, which was just held in Las Vegas last month, where we had a number of corporates and had some good dialogue. And it'll be interesting to compare and contrast what we heard last year and what we heard this year from the companies. So why don't we get into it? Josh, welcome back to the podcast.
Great to be back, Vito.
When we spoke last year, Josh, I think the mood was starting to turn positive. The first half of 23 was fairly light in terms of volume. We saw a significant uptake in the second half of 23, and that's kind of flowed into 24. Certainly when we think about transaction volume, if you use M&A as an indicator, I think, global M&A volumes are up 20% year to date right now. We look at US M&A volumes are up about 30 to 35%. And a lot of that's just driven by a pretty easy comparison in the first half of the year. But certainly as we think about our clients, what are some of the main factors that you were hearing from clients and kind of what's weighing on the industry these days?
When you think back to roughly a year ago, when we last had a sit down post our annual Industrials Conference, in terms of the state of the world, as I was reflecting on this, there's been significant progress. At that time, we're talking September, October of 2023, you had a 10-year, that was at 5%. You had very stubborn inflation. You kind of had a macro backdrop, the likes of which most people hadn't seen in their professional careers. We really didn't have a functional LBO market. IPOs were hypothetical at best, in the event that things get better over the next 12 to 18 months. And you fast forward to today, and no one's ready to sound the all clear today, but it does appear we're at the onset of an easing cycle, coupled with healthy employment numbers, which is usually the recipe for a really good backdrop. So today, we have a vibrant M&A market. It's still a little more, I'd say, a corporate environment than a private equity environment, but private equity is increasingly active. We have a world where, I'll speak for RBC specifically, we've actually done two great IPOs in the sector, both in aerospace and defense, Loar and Standard Aero. So that's a market difference from a year ago. And also just recently, I'm literally talking days, not weeks, we helped lead a financing for a private equity firm, Apollo, taking private public company Barnes Group. So while there are certainly challenges today, which we'll get into, I think just stepping back and reflecting, it is indisputably significantly better today than it was a year ago.
Yeah, no, Josh, I would agree. I think the tone and the sentiment from being in the meetings with a number of clients was a lot more about conversations around key strategic topics. I think they felt good about having their arms around their businesses and sort of how they were looking at that. Certainly, we're sitting here today, a little less than 4 weeks out from the US elections. Clients were certainly focused on that. The geopolitical instability is always impacting whether you have businesses in those areas or not. And, look, I think they felt good about their businesses. I think they felt like they had their house in order, and it was allowing them to think strategically about options that they've considered in the past and some others. I think the one thing I would say is the transactions we're involved in today are generally transactions that have been going on for some time that make good strategic sense. I'm not seeing as much of people necessarily stepping out of their lanes. And maybe we'll see that change once we get through the next month or so, when people feel a bit more comfortable about the forward outlook and start thinking about that. I mean, I think that's generally been the tone.
I think that's right. I think that's a fair distinction to make. I think it is a healthy M&A environment, a healthy M&A market where corporates are still leading the way, but private equity is increasingly relevant. I think the caveat, it's a fair point that you make, is that public company M&A is generally being rewarded, but it has to be strategic and in the zone. Vast departures from the core, kind of experimental new segments that investors are a lot more discerning. And the flip side of this, and this totally is consistent with that, yes, there's a green light for M&A, but it should be in kind of your power lanes, is that we're seeing from large diversified companies a continued trend towards portfolio simplification. I'll give you some examples. Carriers has streamlined its portfolio with fire and security and commercial refrigeration. Honeywell just announced the spin of their advanced materials business. Johnson Controls earlier this year sold off two parts of their HVAC related segment. DuPont spins earlier this year. So absolutely, it's M&A, but investors want people to focus on those areas that they should be focused on. And the kind of the segue I'll have here, and we'll talk about private equity a little bit, is this is creating opportunity for private equity for some of these corporate divestitures where there isn't a natural other corporate buyer or potentially antitrust considerations enter the fray. So where we're seeing quality corporate divestitures, we're seeing a ton of private equity appetite. And naming another name, just we saw this most recently, just a few weeks ago, with the Carrier fire and security assets, where there was a very strong private equity bid and private equity prevailed.
Josh, it's interesting to see a number of these industrial conglomerates now going the route of streamlining their portfolios, where if you go back 10, 20 years ago, they were adding to their portfolios. And so it's an interesting sequence of events, especially as you've got new management teams taking a look at that portfolio. But maybe before we get into some of the private equity side, we certainly on September 19th, the Fed started a rate cutting cycle with a dramatic 50 basis point cut. I think, as we talked about with Lori Calvasina, our US equity market strategist at the Industrials conference, historically, when the Fed has started a rate cutting cycle like this, a year out, we've seen a generally a positive performance from an equity market perspective. There's been a good surge in valuations, and so I think we're going into a cycle that is going to be a positive for our clients. Maybe as we think about some of the resilience that's been shown, and I know a sector you're close to on the construction side, you know, high mortgage rates notwithstanding, with this rate cutting cycle underway, how do you think about that sector as an example, or other sectors that are impacted by some of these macro trends?
Yeah, a large swath of industrials and more broadly, all sectors are tied to interest rates. They're definitely more interest rate sensitive sectors. Anything tied to housing, clearly, people look at interest rates very closely. But in the spirit of dramatic progress, we are almost indisputably entering an easing cycle. Notwithstanding the hotter than expected September jobs report, which pushed the 10-year up a little bit. But I think there's definitely a bias towards easing versus tightening. That would be a dramatic reversal, combined with healthy employment rates. In theory, this is nirvana for the housing sector and construction related sectors. This is what people have been waiting for years. So it's a really good backdrop. It's shown in the public equity markets where multiples are looking ahead. It's shown in the debt yields for some of these names. The flip side of this is that it takes a while for these interest rates, for lower interest rates, to kind of trickle their way into the broader economy and show up in financial results. So, the Fed could start easing, but like I said, the 10-year has remained stubbornly high. Mortgage rates are still north of 6%. So this needs months, quarters to get into the economy before people are going to see it in increased volumes. But the setup is there, the backdrop is there, which is why the equity markets, which obviously look forward, are valuing it. And I think, coming back to M&A and the M&A environment, I think the management teams, the board members, the people that have been in the industry for a long time recognize this favorable backdrop setup. And I think they're willing, knowing that maybe the next quarter or two, it's not going to be, all champagne and caviar, but they could, make a high confidence bet that as you look out 6, 12, certainly 18 months, there's going to be some nice tailwinds there. So yeah, people in the construction related sectors are very excited. This is what they've been waiting for.
And maybe, Josh, what did you hear from some of the other clients in other sub verticals that stood out to you? Any notable developments?
Generally, there are green shoots within industrials. given that there's so many different businesses and so many different drivers. Today, I think I'll start maybe with kind of shared challenges. In large areas, there's been destocking. We've had high interest rates, which do mute spending for various, capital goods, also affect the consumer. So all things will affect most of the industrial sector. But within that, we're seeing really strong activity out of aerospace and defense. One of our strongest franchises at RBC. We've been incredibly active there. I think it stands to reason for everyone here, pretty intuitive, that defense is strong, especially in the tech area. Cybersecurity is kind of an ancillary, business there. The aftermarket for commercial aerospace has also been strong, after pent up demand from the pandemic. And I think, probably the best thing I could say is we've been doing a lot of M&A. There's been a lot of public company M&A. There's been private equity interest in the area. But as I said before, it's actually where the most active pocket for IPO activity. We've had two very successful IPOs in this space, as I mentioned before. So to me, that says a lot about aerospace and defense. Industrial services, generally, critical services related to infrastructure and the grid, and other needs that businesses and people have, regardless of the macroeconomy, they tend to be pretty resilient, all weather businesses. So there's always demand for those. They also tend to be scalable to the extent they're route based. So private equity likes that space. There's also several large caps in that area, the Waste Managements, Republic, GFL, and so forth. So there's been strong activity in services. I'd say even more so when the services, in addition to critical needs and ideally, recurring revenue, subscription-based models, if they touch upon secular themes related to sustainability, energy efficiency, water, infrastructure, technology, even more so. And the valuations, show that, both the transaction valuations as well as the public comps. The last area, and it's a little bit of a catch-all, we tend to call diversified industrials, which itself is incredibly diverse. Some headwinds, some things related to global supply chains, some things certainly related to destocking and higher rates, crimping spending expenditures a little bit. Where there are diversified capital goods businesses that play on data centers, water, electrification, technology, infrastructure, there's clearly a lot of demand and a lot of interest, and we've seen that, for the public corporates as well as from private equity. And I combine that with, building and construction, which, if this easing cycle holds, combined with strong employment rates, it's a really nice backdrop there as well.
We mentioned it earlier. Why don't we get into the private equity topic? We certainly are seeing probably the highest level of sort of in terms of number and value of portfolio companies sitting in private equity portfolios. They're staying in there longer than they have historically. Talked about it last year, there being a pent up demand for deals, both in terms of new transactions and in terms of exiting from existing deals. And that's continued to be the theme, I would say. If I look at it, there was an abnormal amount of private equity exit activity from the second half of 20 into all of 21. Those 18 months were the most we've seen in a long period in history, I believe. And I would say the exit activity has been slower. We've seen some decent activity in terms of new entries. And so there's starting to be somewhat of a constructive LBO market, although I would say we've seen green shoots and we've been participants in it, but it's also early days. But give me some perspective of what you're hearing from the private equity clients, both in terms of newer transactions that they're looking at, but also in terms of how they're considering transactions on the exit side. And I think, Josh, you and I have always said, like, once we get to a constructive market from a financing perspective, we're going back to regular way LBOs versus continuation funds or minority sales or the like that are going on a bit more these days.
I'd say, going back to the beginning, when you take stock of today versus a year ago, there really wasn't a functioning regular way LBO market. Today, there most definitely is. As I said, just in the past few days, we announced the take private of Barnes Group for Apollo, which is required, regular way, traditional LBO financing. We've also done LBO financings. This is just in the past few weeks for Invent and for Archkey. This is RBC, leading the way with underwritten LBO financing. This was not the case last year. Last year, you were looking at structured transactions, 50-50, existing owners rolling their equity to keep the capital structure in place. So it's a huge, huge difference from last year. However, we are not nowhere near where we were in 2020, 2021, where it was, it was a feeding frenzy. And private equity right now is being more discerning. These are broad statements, but it's difficult to get perfect data on this. But I think if you did, it would definitely bear this out. I think right now, definitely a preference for take privates, corporate divestitures. I also mentioned corporate divestitures versus private equity, sponsor to sponsor deals. Now, that's not to say that they're not going to do sponsor to sponsor deals, but it just seems like the bar is higher. So there's a functioning LBO market. There is private equity appetite, but it remains discerning. And the other thing I have to say is that while there is a regular way LBO financing market, it is not back to what it was in 2020 and 21 in terms of the quantum of debt and the cost of debt, obviously. I mean, base rates are still now much higher than they were back then.
We all see a constructive market forming and hope that it continues to progress. I think it's definitely accelerating at a slower pace than we would have anticipated, but that's to be understood right now. And I think there's all the conditions exist and look like they're going to exist going into 25 for a continued strong market there. I mean, the other piece we always talk about, Josh, is just trying to make sure that even large private equity assets have multiple alternatives. And one of them that you mentioned earlier, that it's been great to see that market revived a bit, is on the IPO side. And we take a look at like Standard Arrow out of Carlyle's portfolio having what I would call a very successful IPO so far. Certainly upsized from a billion to 1.4. Priced at $24 a share, currently trading above 32 per share. I think there was an appetite out there for a strong industrial business like this, especially in aerospace and defense. Maybe give me some thoughts on the IPO market and how you're seeing it as a true alternative for some of our clients that are thinking about monetizations.
Yeah, well, no, first off, like I said, it is not, the all clear on the IPO market for most of industrials. Aerospace and defense has been a shining star, though. The rest of industrials, it's been more muted. There is a real backlog forming. And I think the setup and the backdrop is getting there. And I think we are going to see much more, broader participation in the industrials IPO market heading into 2025, which is great. And by the way, this also dovetails to our conversation on private equity, because if there's a more muted or higher thresholds, for private equity to exit via sale to private equity, if you have a high quality asset that there may not be a natural strategic buyer for, the IPO is an incredibly viable and incredibly attractive exit option. So I think there are going to be a lot of private equity firms that are going to look to this IPO market. I'm very focused on this. There's a lot of assets lined up. And, the IPO markets, vast segments of the financial markets, once one person goes, kind of clears the way. So this is exciting. We haven't yet reached that inflection point, but it is a dramatic difference versus a year ago, where you mentioned these A&D IPOs. So as we look into 2025, I think for industrials IPOs, we're hoping that's the next inflection point, broader participation there.
It's a clear sign that there's there are certainly funds on the sidelines with money to put to work looking for opportunities. And I think businesses like Standard Arrow and others that are making it out there right now are getting rewarded at being at the front end of it, which is good to see. Josh, and just kind of finishing up the conversation here, we're not in the business of predicting what's going to happen in the forward markets, let alone an election that's coming up in a little less than 4 weeks. But you and I and others are constantly getting questions from clients about how to prepare themselves depending on which party is in control, and sort of what their primary objectives are. But maybe as you talk to clients, what are some of the elements that dominate the conversation? Are you seeing people take a pause until we have clarity, or are you seeing them move ahead? I mean, we talked a little earlier about, we've got a number of situations where clients are pursuing strategic transactions that they've been looking at for a while, and they're not pausing to wait for the election results.
I think in terms of rates and inflation, people are directionally getting comfort with where we're going. So I'm not saying that's completely off the table, but there's confidence management teams in the field, board level, that we know where that's going directionally, knowing always that there could be two steps forward, one step back. In terms of the election, which is less than a month away, I think people are taking. I think first of all, for highly strategic M&A, the kinds of things that corporates want to own forever, that they're forging ahead. I think there are tactical considerations related to volatility. If you're dealing with public equity or public debt, where you do want to manage around the election, either before or after it. But for the most part, this core highly strategic M&A, that just goes on. But you manage your timelines accordingly. The election is highlighted in every deal timeline. But with regards to the election, itself, what are people focused on? The antitrust environment for sure, and to the extent that the election outcome could change that favorably or keep the status quo. I think people have their eyes on that. Where does that come into play on a practical level? If there is a deal where there are antitrust considerations, maybe you are waiting to see what happens after the election. I think the other related ones, which are specific to various sectors, are with regards to tariffs. Depending on how the election goes, what, if any, tariffs are put in place, how deep and broad they go. And for certain areas of industrials, that's a big deal. The other thing is tax rates. As you get into certain pockets, there are specific regulatory considerations that the election outcome, both federally and some of the local elections, can have an impact on. So it's a real thing. But I think, like as you noted in your setup, if you long term have a coveted asset, a must have asset, the outcome of the election is probably not going to sway you. But it is a tactical consideration around timeline. I think that the appetite for management and boards to do large deals now closer to the core. I think still kind of the new adjacencies and more experimental growth platforms TBD, but larger deals in strategically important areas. I feel like the appetite is as strong as I've seen, certainly in the past 15 years. And I was reflecting on this because it's a little bit of a change in sentiment from defense, maybe in the 2010s, to offense today. But that long, dark shadow of the global financial crisis, the GFC, going back to 2008, 2009, I think that was a real shadow that was cast over boards and management teams when they were looking at M&A. And I think there was a little bit more of a defensive mindset. And here we are about 15 years later. And I think that shadow, I won't say it's completely gone, but it's a lot narrower, it's a lot paler. And part of this is just you could go look at the management teams and boards, and you could see that a lot of the people that were in those seats in '08 or '09, and they're gone. And this is just a human element that if the people have turned over, there's been a transition, new people come in, new mindset. And by the way, no one is saying people should forget what happened during the GFC. I mean, obviously, you have to manage risk accordingly, but I think it is a little bit of a different mindset in industrials, which I think bodes well for increased and larger M&A activity.
I know, Josh, I agree with you on that sentiment. I mean, that's an excellent point. I think if I were to think about it in general, and we've looked at a lot of these statistics historically, if you look at cash on balance sheets at S&P 500 companies as an indicator, and you look at it at the end of the GFC, sort of the end of '08 timeframe to now, it's over 2x when you look at it. And even if you take out sort of the buildup in cash on technology balance sheets, which is usually where the biggest ones are, it's still on a per head basis is significant. And so I think, you're right. Boards and C-suites found themselves getting a little too close to the edge during the global financial crisis. They probably, as the pendulum always goes, kind of overdid it in terms of building up cash and getting themselves ready. The other thing that's happened, Josh, I think that I'd add to your points is that during COVID, in sort of the 2020-21 timeframe, and then just the year or two, after that, we definitely saw companies take care of their own house in a bigger fashion, whether it was determine which assets they were going to keep, what they were going to divest, but they also made sure that they took advantage of the lower financing rates that were available to them to properly set themselves up going forward. And so we're going to see a bunch of that refinancing happening in the debt capital markets in the coming years, just in terms of some of the COVID financings. But at the same time, they're sitting in a much better position from a leverage perspective, cash on balance sheets. And so now it becomes a capital allocation question. I think there's an opportunity here, and especially you look at the boards, and in many cases now, the C suites have been in there for a period of time. They own these companies, and they're trying to think about, what do I do next? And I think the comfort of adding in their lane is important. Now, you made the point as we think about the election that's coming up. Um, I do think if we're looking at folks that are considering something larger and more strategic like that, they'd like to understand where regulatory policy is going on a go forward basis to get greater comfort. Um, but also, look, we've talked about it, and we've maintained a dialogue with the different agencies on that topic. Their focus is on the larger platforms. Their focus is on the larger conglomerates. Um, I think there's, good strategic transactions are getting done, and certainly they're getting a more extensive review, but they're getting through those processes. And we are helping a lot of clients manage those. Josh, I've really enjoyed the conversation. I think we've got an interesting time frame ahead of us, and I'm pretty excited about what's ahead in the next 12, 18, 24 months, because it feels like there's a good level of activity to be had across your sector and others. So thank you for the conversation. Look forward to having you back.
Great. Thanks, Vito.
You have been listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on October 9th, 2024. Listen and subscribe to Strategic Alternatives on Apple Podcasts, Spotify, or wherever you listen to your podcasts. If you enjoyed the podcast, please leave us a review and share the podcast with others. Thank you.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.